All right, fams, how we doing? Hope we're having a very lovely day and a blessed week. Let me do a quick recap before I go straight to the business of today without much admonishment. In the last video, we talked about market structure. We talked about the definition of market structure, how market structure is the skeletal part of the market. The framework, basically what helps us identify if the market is bullish, bearish, or range. It helps us to analyze the market. Without all those things here, we won't be able to tell and we won't be able to predict the market in our favor. So market structure is what helps us to do all those analyzing. You understand? And we also gave types of markets. We didn't go deep much into it in details, but we said there were three types of markets. We said there's a bullish market, which is the upward market, the bearish market, which is the downward market, and the range market is neither going up or down. It's just ranging sideways. I also gave you chart examples about what these three types of markets are. So now today we'll be dealing with types of market structure, all right? The bullish market structure, the bearish market structure, and the range market structure. I talked about it, but today we're going to be going more into details about how this market operates and how they are being traded. So, first things first, let's start with the bullish market. We said the bullish market is an uptrend market. If you see the market sloping upwards, it is called a bullish market. You understand? Then we said the bearish market is the market that if you go to your chart and you see, let's do what? If you go to your chart and you see the market, you see the market just sloping downwards like this. It is basically called the bearish market. Then lastly, we said if the market is neither going up or down, this is called a range market. Just gallivanting and consolidating at a point, it is called a range market. All right, I've forgotten that one. Yeah. Now, this is where we're going to get new notes now, like opening a fresh page in your jotter and let's write. Right? So now, in the bullish market consists of two major parts, which is the higher high and the higher low. The bullish market consists of two major parts, the higher high and the higher low. The higher high being the higher part of the swing, then the higher low being the lower part of the swing in a bullish market. I'll come again. The bullish market consists of the higher high and the higher low. The higher high being the higher part of the swing and the higher low being the lower part of the swing. Now, for a bearish market, the bearish market consists of two major parts also, which is the lower high and the lower low. The lower high, which we identify as the LH, is the higher part of the swing in a bearish market, and the lower low is the lower part of the swing in a bearish market. While the range, to not overcomplicate things in the range, we just call the upper part of the range the highs and the lower part the lows. You understand? Because we don't necessarily trade the range markets. We only wait for a breakout for it to change into the bullish or the bearish market. All right, these are basically the two types of markets we trade, the bullish and the bearish. All right, so now back to the bullish market. If you open your chart, let's say you come to your chart now, you want to trade. The first thing for you to understand, the first thing to come to your mind is to identify the trend of the market. Is the market bullish? Is it bearish? Is it range? If the market is bullish, you're looking to buy for that day. You understand? We buy in a bullish market. And if the market is bearish, we look to sell. How to buy and how to sell is a topic we'll still deal with. You understand? How to buy, how to sell, where to enter trades. Those are what we'll discuss later on. But you need to understand that if the market is coming down, it's a bearish market, and the only thing that should come to your head for that day is to sell. And if the market is going upward, it is a bullish market, and the only thing that should come to your mind at that particular time is to buy. While in a range market, just quietly leave your chart alone till the market gives you an opportunity to buy or sell. Now back to our drawing board. Another way to identify a bullish market, if you see market keeps making a higher high and higher low, breaks above the last higher high, creates another new higher high, a higher low, higher high, higher low. If you see the market sloping upward like this, it is clearly a bullish market. Then if you see the market creating lower lows, lower highs, breaks lower than this lower low here to form a new lower low, new lower high, keeps on going down in that pattern, it is called a bearish market. And there is a reason why the market does not just move smoothly like that the market is not just going up and it's not just going down. It's more of like a tennis ball. If you throw a tennis ball to the floor, the first momentum you use to throw that ball is going to make the ball bounce and bounce, and within time it will start, reducing in tension while bouncing. That is basically how the market works. The market has to retrace. It has to pause, gain momentum again before pushing phase again. You understand? Exactly. That's how the market works. And if the buyers are reducing the market and sellers are more than the buyers, you see the market turning bearish. You understand? Now, let me digress a little bit. Sorry. These are foundational things of the market, types of market structure, like they are foundational. If you don't have knowledge about how these things work, when we start getting to the advanced things, it will look complicated to you. Meanwhile, trading is not meant to be complicated. You understand? It will look complicated to you. So like this now, you need to pay close attention to these foundational things. It's more of like, let's say, while you're still in school, another example of trading, let me relate it to school activities. We have in mathematics, subtraction, addition, and multiplication. These are foundational things. Some schools call it board maths. You understand? These are foundational things you ought to know about mathematics. So when you start getting to advanced topics like simultaneous equation and quadratic equation, it won't look so complicated to you because you have some foundational truths. All you just need to know is how to put them in place. Same applies in trading. If you know market structure very well and you know how the markets work structurally, once you start getting to more advanced topics like other blocks, so liquidity and all those type of stuff, it won't be too complicated for you. Now back to the business. So that is basically how the bullish market works and the bearish market. The market cannot just continue going upward forever without retracing. It has to, go up, create a higher high, retrace a little bit like it's breathing, then create a higher low. Then once the market breaks past this last higher high here, it is said to be a valid bullish structure. Then it creates a new higher high here, then higher low, and continue going up. You understand? Same goes for a bearish market also. If the market comes down and creates a higher low, it has to, more of like a breathing, a retracement, comes back before pushing face again, then goes up slowly again, push face again. Then we know this is a valid bearish market. Meanwhile, the range, we just avoid it till it either breaks to be a bullish trend or it breaks to be a bearish trend. Now, I know there are some concepts here that might be confusing for you, like the higher high and the higher low. With time, if you stay, long enough studying, it won't be a problem. The higher highs and the higher lows will just come naturally, and you just be naming them. When I first started also, I was like, well, this thing is complicated for me to learn, but with time, everything will just register in your head automatically. And I wrote some notes here that you need to take. There are some things here like you need to take note of. The first one I wrote is, the upper part of the bullish market is called the higher high, which is this. These are the upper parts of the bullish market. And the lower part is called the higher low, which is this part. All right? The second one I wrote is, the upper part of a bearish market is called a lower high, which is this part. All right? And the lower part is called the lower low, the LL. All right? While in the range, we only have the highs and the lows, which is the upper part, which is the highs, and the lower part, which is the low. Hope I was not so fast. Now, this is all you need to know. Basically all you need to know about the types of market structure. Any other thing you are learning, as what I just explained now, is complementary. You understand? Don't overcomplicate your study. While you start, and make everything as simple as possible. All right. So in the next video, we're going to be talking about more things about market structure. We've known the definition of market structure now and the types of markets. So catch you on the next video. Cheers and God bless.